Thinking about using your super to invest in property? I'm about to show you the exact rules, risks, and lender requirements most Australians don't see coming. And these insights could save you from double stamp duty, compliance penalties, and missing out on 30% of your property's growth. Maybe you've heard you can buy an investment property through a self-managed super fund. Lower your tax, rental income in retirement, and full control of the asset. Sounds brilliant, right? But then someone mentions limited recourse borrowing, 80% LVRs, liquidity buffers, and suddenly you're wondering, is this the right move or a very expensive mistake? I'm Nick from Trellis Finance. Over the past decade, I've helped hundreds of clients structure their loans from first home buyers to professional investors. I've seen SMSF property work brilliantly, and I've seen it go horribly wrong. In the next 8 minutes, you'll learn how SMSF property investing actually works, what you can and can't do, the real borrowing numbers, and the risks most people miss. By the end, you'll know if it suits you or if you should walk away. Before I dive into all of this, remember that this is just general information and should not be taken as financial advice. Always seek independent advice from your own financial advisor or your accountant. Let's get into it. First, let's clear things up. What exactly does super do when it comes to property? A self-managed super fund lets you control where your super is invested. Instead of leaving it in a standard fund, investing in shares or managed funds, you can set up an SMSF and use that money to buy residential property or even commercial property. The appeal is simple. Rental income inside your SMSF is taxed at just 15% while you're working. Once you hit the preservation age and move into the pension phase, that rental income becomes completely tax-free. And if you sell the property in retirement, capital gains can also be tax-free. But here's where it gets tricky. You can't just roll your super into a self-managed super fund, buy a property and call it a day. There are strict ATO policies and lender-specific requirements. There are also liquidity buffers, contribution caps, and compliance obligations. And if you get any of this wrong, you could face double stamp duty, hefty penalties, or even lose access to the concessional tax rate that made this attractive in the first place. So before you do anything, you need to understand 3 things: what the rules allow, what lenders actually require, and whether the numbers stack up. Because unlike personal property investing, SMSF lending is a completely different game. You can't negative gear, you can't release equity, and every dollar that services the loan has to come from inside the fund. So let's break down exactly how this works. Firstly, the biggest thing you need to understand when it comes to an SMSF property is that there are non-negotiable ATO rules that can easily trip you up if you don't follow them. Rule number 1, you can't live in the property. This has to be solely for investment for your retirement benefit. No exceptions. Rule number 2, you can't rent it out to your family members. That includes your kids, your parents, and any other related party. The ATO considers this to be a personal benefit, which breaks the sole purpose test. Rule number 3, you can't use personal cash to pay the loan. All repayments must come from within the SMSF. That means employer contributions, salary sacrifice contributions, or rental income. If you try to top it up with your own money outside super, you're breaching compliance. Rule number 4, you can buy off the plan, but only if the land and build form a single contract. If you buy land separately and then enter into a build to suit contract, that's not allowed either. Rule number 5, you can't release equity. If you buy a property for $500,000 and 5 years later it's worth $700,000, you can't borrow against that $200,000 gain to buy your next property. You'd need to sell, pay down the debt, and reinvest what's left. I know this sounds restrictive, and it is, but these rules exist to protect your retirement savings. The ATO doesn't want you treating super like a personal piggy bank. So if you're considering SMSF property, you need to be comfortable operating within these boundaries. Now, here's one myth I need to bust. A lot of people assume SMSF property investing works the same as the first home super saver scheme. It's a big word. It doesn't. The FHSSS lets you withdraw voluntary contributions to help buy a home to live in. SMSF property investing is about buying investment properties you'll never live in, using a completely separate structure. They are not the same thing, and confusing them is one of the most common mistakes I see. So now you know the rules. But rules are one thing. What lenders actually let you borrow and how they assess your capacity is another matter. And this is where most people get the biggest surprise. So here's what lenders are looking for when you apply for an SMSF loan. First, loan to value ratios. Most lenders cap residential SMSF loans at an 80% LVR. So if you want to buy an $800,000 property, you'll need at least $160,000 as your deposit. For commercial property, that LVR drops even further, sometimes between 60 and 70%. Unlike personal lending, lender's mortgage insurance isn't available for SMSF loans. So if you don't have the deposit, you can't borrow. Second, liquidity buffers. Lenders typically want to see around 5% of the amount held in cash inside the SMSF. So if you're borrowing $500,000, they want roughly $25,000 sitting in your SMSF bank account as a buffer. This is to prove that the fund can handle repayments if the rental income dries up or contributions stop. Third, borrowing capacity. Lenders assess how much you can borrow based on 3 income sources: employer contributions, salary sacrifice contributions, and rental income from the property. They don't look at your personal living expenses because the SMSF doesn't have any. But they do shade rental income, usually to 80%, and apply assessment buffers to ensure the fund can service the debt. Fourth, contribution history. Most lenders want to see at least 12 months of consistent contributions flowing into the SMSF. If you've just set up the fund yesterday and rolled over $300,000, that's not enough. They want to see that you've been contributing regularly and that the fund is viable long-term. And here's something most people don't know. Because you're only borrowing around 70 to 80% instead of 95% like a standard home loan, your borrowing capacity requirements are actually lower. So someone who can't borrow $760,000 personally might only need to borrow $540,000 through an SMSF to buy the same property at $800,000. That difference can open doors for people who have maxed out their personal borrowing capacity. It can change everything. Now, let me walk you through a simple example so you can see how this plays out in practice. Let's say you and your partner have a combined super balance of $300,000. You want to buy a residential property worth $520,000. Here's how the numbers work. You'll need a 20% deposit, which is $104,000, add in stamp duty and legal costs, and you're looking at around $130,000 to $140,000 in total upfront costs. That leaves you with roughly $160,000 to $170,000 still sitting in the SMSF. You'll borrow around $416,000 at 80% LVR, and let's assume the property yields 4% gross rental income. That's about $20,800 per year, or roughly $1,733 per month. After the lender shades that income at 80%, they're assessing $1,386 per month. Add in your employer contributions and any salary sacrifice, and you've got enough to service the loan. Over time, employer contributions and rental income gradually pay down the loan. If you assume 5% annual capital growth, that $520,000 property could be worth $847,000 in 10 years. If the loan is fully paid off by then, that's $847,000 in your super, all taxed at concessional rates. Now compare that to keeping the same $300,000 in a traditional super fund invested in shares. At a conservative 6 to 7% return, you'd have around $590,000 in 10 years. The property strategy delivered $847,000. That's a $257,000 difference. And in retirement, the rental income is completely tax-free. But before you rush out and set this up, let me show you the risks that most people overlook. Stick around because knowing these could be the difference between property investment success or a costly mistake. Risk 1, you can't access the property equity. If property prices rise and you want to buy a second property, you can't just refinance and pull out like you would personally. You need to sell, pay capital gains tax if you're still in accumulation phase, and then reinvest what's left. Risk 2, compliance mistakes are expensive. If you rent the property out to a family member, even accidentally, or if you pay the loan with personal funds, the ATO can hit you with penalties and strip the fund of its concessional tax status. I've seen people cop double stamp duty because they put the wrong entity on the contract. Risk 3, borrowing capacity is capped. Once you've used your super balance and borrowing capacity within the SMSF, you can't easily scale up the way you would with a personal portfolio. You're limited by contribution caps, which are currently $30,000 per year for concessional contributions. So who would actually consider this strategy? Well, it's most ideal for investors who have maxed out their personal borrowing capacity. It's also great for business owners or high-income earners who want to salary sacrifice into super and use that to fund property. And it works well for people who are in their 40s or 50s who have time to pay down the loan before retirement but want to lock in the concessional tax rates now. But if you're someone who wants flexibility, who might need to access equity, or who's not comfortable with strict compliance rules, this probably isn't the right fit. And that's okay. There are other strategies that might suit you better. And here's the most important part. If you're someone who lacks financial discipline, has a history of missed repayments, or defaulted, SMSF property is not going to be for you. This strategy requires you to be financially stable, consistent, And if you can't service the loan from inside the fund, there's no safety net to fall back on. So while SMSF property investing is powerful, it's not for everyone. It works best for people with stable income, existing super balances, and a clear longer-term plan. You now have something most people considering SMSF property don't. A clear picture of how this actually works, what lenders will and won't approve, and the real risks you need to plan for. But here's the reality. Knowing the strategy is one thing. Knowing whether your specific numbers work, which lender will actually approve you, and how to structure it correctly from day one is another. That's where I come in. Book a call with us at Trellis Finance. We'll assess your super balance, calculate your exact borrowing capacity, and give you a clear step-by-step roadmap so you know whether this strategy makes sense for you or if there's a better solution. No guesswork, no confusion, just a clear plan tailored to your situation. Links in the description below. Let's make sure your super is working as hard as you did to build it. See you in the next one.